Hello, hello. Hopefully no technology issues this time around. Welcome to tonight's session. We'll get started here in about 2 minutes. Wait for people to funnel in. It's going to be a fun one, probably looking at a lot of stocks that normally you do not look at. Should be exciting. We're going to be focused on areas of the market that most people do not normally pay attention to. And hopefully throughout the process, you'll be able to find some stocks that maybe are worth an opportunity to take. So go ahead and wait here. Hopefully everyone's having a great night. Looks like it is working finally. No technology issues whatsoever, so that's great. Been a wild couple of days, has it not? Okay, so regardless of where you're watching this from or when you're watching this, if you're interested in the services at the end of this webinar here, I'm going to go ahead and post a link inside of the chat. You should be able to access that at the end. If you're interested in participating within the Trading Initiative, that is the quarterly membership, and that will get you access to everything that we're going over tonight. 5 to 10 trade ideas per week. You'll see a sample of those in today's webinar. 1 to 2 newsletters per day with all pertinent information, at least what I think pertinent. And hopefully you'll find value and make some better trades. So without further ado, let's go ahead and get started here. Welcome to September 4th, 2024, our monthly chartathon. We run these every 2 weeks. The goal here is to build a bigger time frame plan. The theme here, navigating the end of summer volatility. Disclaimer first, don't be stupid, don't risk more than you can lose, and don't misconstrue anything we say today as buy or sell recommendations. We're looking at charts here. You are adults. You have control over your own money. The 3 tenets of TTI, for those of you that are new and joining us for the first time, we focus on price and price alone. News is noise and everyone else lies. Absolute and relative strength. We want to own the strongest stocks in uptrends. And when we're in bear markets and in downtrends, we want to short the weakest stocks. Yes, that is the winning combination. And then lastly, momentum. We want to buy stocks that are showing rapid movement towards the price targets, whether that's low volatility or high beta. We're going to be going through both types of trades today. We need momentum on our side to make these worth our time as trading vehicles. I was going through the Stock Traders Almanac for this year earlier today, and I found a funny quote starting off September. Portfolio managers back after Labor Day tend to clean house in September. If you're not aware, what I'm about to show you is the last 10 years of the NASDAQ performance segmented out by month. And if you think September is a great month, I have some bad news for you. That red box there highlights the last 10 years worth of September's moves in the NASDAQ. Now, the S&P 500 is relatively the same, but I'm highlighting NASDAQ because most people that are trading trade tech, consumer discretionary, and communications names, even if they don't mean to. Generally, traders are attracted to higher beta stocks. They move more than the benchmark. They move faster. Typically, options trades are more profitable when they work, but also they hurt a lot more when they don't work. So heading into September here, that quote that generally portfolio managers look to lean into September by pairing bad positions and setting themselves up for success through year end is 100% true. September is, on average, the weakest month of the year. Going back 10 years, an average of negative 2.25. Now, the S&P 500 is slightly better than that, but still negative overall over the last 10 years. Even if you take out that outlier in 2022, it is still a very weak month. Now, before people misconstrue that as me saying there's going to be new lows, new bear market lows, we're going to capitulate, please understand that 2.25% is not that big of a drop. It just goes to show you that generally speaking, September is weaker than other months. Feel free to figure out why that is. There's a million different ideas. I tend to think it's because the bigwigs on Wall Street come back from summer and they go, holy shit, look what the prices are on these stocks. Let's get rid of them. Realistically, it's a bunch of different combinations, fund flows, everything else. But that's a tradable stat. So knowing that September is going to be weaker, maybe you take less positions, sit on the sidelines a little bit, accrue cash, because you know what happens traditionally in October, November, December. Very, very good months to be vested long in the market, particularly during the fourth year of an election cycle. We've beat that topic to death. So we're going to save that until probably October to talk through it one more time. U.S. sector performance year to date. Who had utilities leading in the second year of a bull market? Not many people, guys. We have been bulled up since January of 2023, not the absolute low, which is October of 2022. But by the time semiconductors started to break out and NVIDIA started to break out, we were like, listen, there's a good indication this market has bottomed out and potentially going higher. We put a bunch of content out on YouTube around that time as well. We were buying long. Generally speaking, in bull markets, not necessarily, outside of the second year, third year, fourth year argument, utilities generally do not lead. So this has been a crux in the side of bullish investors and traders all year. People that want this market to drop continually say utilities cannot be leading, specifically in the second year of a bull market. And traditionally that's true. But guess what? I guess it's the first time ever, right? Utilities are leading here. Financials up 21.48. Communications, your Googles and Metas, your telecoms like Verizon and T-Mobile, your Netflixes up 18.2, consumer staples up 17.2. This is a drastic change from the July 10th top that we saw in the markets where tech was leading. Over the last few months, we have seen rotation out of higher beta stocks and into lower volatility stocks. There's a reason, if you're inside of TTI, that we've been opening up a lot of lower volatility stocks over the last 6 to 8 weeks. We've been opening up consumer staples, financials, real estate. It all comes down to these trends we see on Koyfin every 2 weeks. 3-month performance. Who had real estate up the most since June? Not me, but here we are, up 16.13. Financials up damn near 10%. Consumer staples up 8.38. Healthcare up 8.35. Not once did I say anything about tech. As a matter of fact, over the last 3 months, tech is down. Not once did I say anything about consumer discretionary. Consumer discretionary is up 5.22%. There are other areas of the market that you can be actively trading through summer months that might yield you better results. You do not need to beat a dead horse on the tech stocks, the consumer discretionary stocks, and the communication stocks yet. There will be a time and place, but when the market is giving you a different type of trade to take the trade. Adjust the time frame and take the trade. Energy also down 2% over the last 3 months. Oil is basically a dead trade. Semiconductors still leading, up 28.95% year-to-date performance. I want you to go ahead and look at how high semiconductors were at their peak on July 10th. They were up 65-ish% on the year. They have drawn down massively, and they are still outperforming every other industry group. That is how much outperformance there was through the first 7 months of the year. That's why, personally, when people are talking about semiconductors being a bad trade because they're overvalued, as a technical trader, I don't give a shit about anything being overvalued. I care about what price and trends are telling us. If you missed any part of the semiconductor trade for the first 7 months, but realistically going back to last year, you missed out on an incredible opportunity to make a lot of money. Over the last 2 or 3 months, it has been a tough trade, which is why, once again, we haven't opened up a bunch of semiconductors. As a matter of fact, we haven't opened up a single semiconductor as a community over the last 2 or 3 months because they're in downtrends right now. We'll talk about that in a second. Do we expect them to continue to be? Probably not, but we do not want to be buying the dip until there is some form of divergence and momentum to the upside, or we start to see higher highs. As of right now, it's just not there. Who had insurance up second? KIE up 25.56% year to date. Insurance. We're going to go through a bunch of insurance names later today. These are not sexy areas to be trading. You're not going to, text your group chat that you bought Progressive or Aflac or Travelers Insurance. These are not trades that typically get people all riled up. But guess what's performing the best this year? Travelers, Progressive, and Aflac. So regardless of whether or not you want to own them, that is where the strength is. So if you can get out of your own head for a second, not worry about the Apples and the Microsofts and the Metas, because those are not the only trading vehicles. You're in here to trade. Look for strength in the market. Oil, to a certain extent, AMLP has a different type of industry group of the energy sector. They own more rights than anything else, up 17.06% this year. The benchmark up 16.62. Check out Home Builders up 15.49. Then everything else pretty much falls off underneath that. By the way, software stocks only up 4.46 on the year, and internet stocks only up 5.83. So if you've been long software or internet stocks only this year, which are realistically traders' favorites because once again they're higher beta, you've underperformed this year. You have. Buy the things that are outperforming the benchmark. Over the last 3 months, who had regional banks on their list as the number one leading industry group since June? Not me. Once again, this is why we own bank stocks. I don't try to predict this stuff. We just follow trends. Regional banks have outperformed every other industry group since June. REITs, 15.75. Home builders up 11.5. Insurance up 11.4. Those are 4 low volatility, more defensive-esque types of sectors. You're not getting these high-flying, double-digit ADR type names like you see typically in software, which is up 8.74. But internet, these small and mid-cap names that really rip and everybody loves to trade them because they move a lot, they're not performing well since those July highs. And we see that reflected in the year-to-date and 3-month performances. Factor analysis all year up until that July peak. Once again, as you can see, the safety trade was large cap growth. That's it. Large cap growth. Buy the Apples, buy the Microsofts, buy the Amazons. Most of these names are breaking out into all-time highs. As a matter of fact, a couple of them are still there. Not necessarily hitting all-time highs, but hanging out up there, right? Since the July top, July 10th through the 16th, depending on what actual ticker you're looking at, we have seen a roll into other areas of the market, right? Some rotation out of those large cap growth stocks and into some underserved small, mid, and large cap value related names. The safe trade of the Mag 7 stocks has been disaligned from the broader market move. As a matter of fact, we're going to see this in a second. The broader market is outperforming the Mag 7 stocks over the last few months, not weeks, not days, months. Market breadth is improving, and you can see it partially through this factor analysis performance year to date. And then once again, when we look at the 3-month, look at where large cap growth is. Large cap growth is sitting right in the middle of the pack, right? Down 1.03. What's leading right now? Nobody's favorite area to trade, large cap value. Large cap value, these are your banks. These are your real estate names. To a certain extent, these are your healthcare names. These are names nobody wants to go and buy, but these are the names that are outperforming the S&P 500 right now. So you got to go and buy them. I mean, if you want to outperform and you don't want to sit on your hands, these are the areas you want to be interested in right now. So I want to start this whole thing off with, addressing the elephant in the room here. This went out today in the newsletter. Everybody is screaming that the AI bubble popped. End of the market. It's like clockwork. Every time the market pulls back, even if we expect it to pull back due to seasonality, people start freaking out and they expect the world is going to end. Guys, it's probably not going to end. I've been saying that for forever, but realistically since January of 2023, when it was obvious, at least to me, that the market was shifting into a bull market, that the world was not going to end on every pullback. It's just not. Tech tends to lead in a bull market, totally understandable. But as you can see, this relationship, the tech sector against the S&P 500, does it not make sense if you're a technical trader to find resistance at previous areas of contention? Guys, this is TA 101. So for everybody expecting technology to roll over here, you're expecting a new bear market low probably if technology is going to meet resistance at those previous highs and then roll back down. That's probably going to ensure a bear market is on its way. The other way to focus on this is we are fighting against previous cycle highs and we will eventually flip them and turn that resistance area into a support. This is basic technical analysis. What just happened this year? Semiconductors. And this is the big takeaway from this. Technology has 3 different main industry groups: software, internet, and semiconductors. What has been the industry group to trade over the last 18 months? Semiconductors. Does this chart not look almost damn near the same as tech? Yes, it found resistance at those previous 2000 highs. It took a little while for the semiconductor industry group to eventually break out over it. And once it did, flipped it into a support level and took off. That's almost an entire year of overperformance against the S&P 500. Now tell me, if arguably the most important industry group in the world and a very large component of the technology sector, do you expect tech not to make the same move? I do. I absolutely do. Now, I'm not in the business of trying to time exactly when that happens. I don't do that. I don't like timing the market. I think most people that time the market are full of shit. You can't predict stuff to that high of degree your entire life and not be a trillionaire. So if you're making your living off of predicting the exact time things are going to pivot, you're going to have a very tough time in the market over a long term. Instead, I look at these relationships as components within a broader picture. Semiconductors broke out against that resistance area, flipped it, and went on an absolutely insane run for 12 months. It's a major component of the tech sector. Going back really quick, does it not appear to be damn near the same chart? And if we are in the second year of a bull market, and generally bull markets last 3.5 to 4 years, is it not reasonable to expect that this will also make the same flip that semiconductors do? I mean, we have software stocks pressing up into all-time highs right now. Internet stocks are lagging a little bit. Semiconductors were at all-time highs till a couple of weeks ago, I guess months ago at this point, July. Yeah, I think it's reasonable to assume that tech is going to continue to break out. That's where my money is. So if I'm wrong, I'm going to lose money on that idea. And that's totally fine with me. But that's how I go about this stuff. I look at relationships, look at the constituents inside, and go, what's the path of least resistance? Is it up or down for tech? Right now, it looks like it's consolidating at previous levels. Speaking of consolidating at previous levels of contention, here's that S&P 500 weekly chart. We set this back in December of 2023, that Fibonacci range. Go back and fact check me every single monthly and mid-monthly charting session that we've put out on public YouTube. This has not changed, and here we are finding resistance at that fib level, 557. For those of you that don't believe in fib levels, that's totally fine, but a lot of people do. And you'll find that institutional selling tends to occur near or around those fib levels. It doesn't have to be perfect, but it allows us to set price targets and set expectations. Is it a surprise to see some slight resistance up here at the 557? No. Not at all. And as you're going to see across multiple charts, they look damn near the same. The Qs found resistance at the fib level. Once again, set those back in December of 2023. And by the way, I want to highlight something which we're going to go through in a second. Summer trading is choppy. It's volatile. Very little actually happens. Volume is low. You want to know why? People on Wall Street go on vacation. The rest of us degenerates are sitting on our fucking computers trying to squeeze rocks and make water. It's very challenging to trade during the summer. And yet, every summer, we go through this and people go, I think I'm just going to take a vacation, or I think I'm going to take a step back, or I'm going to take it a little bit lighter. Maybe instead of going full R into positions, I'm going half R. And yet they still do it. And that they relearn that lesson every year. I highlighted summer of 2023 when the market started to break down into October. We were threatening to break the 200-day moving average, and bulls were throwing the towel in. Now, don't get me wrong. I was prepared for both scenarios. We had talked about it inside of TTI. There was just as much of an opportunity to take this short as it was to go long. But at the end of October, there were a couple key features that made us want to continue to push long. I'm not going to get into them right now. It's on YouTube publicly. You can go back and watch that. But we had some bond divergences, some momentum divergences, and we go, fuck it, let's buy the end of October. Some key things are happening. That ended up being the right call. So I'm highlighting here summer of 2024. Yes, it's a lot more volatile because the Japanese yen carry trade blew up the market on August 5th. But is it that much different than summer of 2023? Have things changed that much? Not really, at least from a technical standpoint. You could argue that the uninversion of the interest rates and everything else, you want to argue recession, be my guest. That's not my game. I'm a technical trader. I'm not trying to predict the economy or anything else. But I'm looking at this chart and I'm going, that looks pretty much the same. And we know that seasonally the summer is weak. So I'm not worried at all. The only thing I'm going to do is continue to buy names that are showing relative and absolute strength. And as of right now, that's not tech or consumer discretionary or communications. I have old positions on the books. A lot of them are free. I'm going to continue to hold those through the year end, right? Because tech will probably come back. I'm not buying the dip yet. We're going to wait for this thing to find some sort of floor. Once again, small caps. This has been a hell of a choppy 2 years plus for small caps. You want to talk about how hard it is trading. Guys, 2+ years, small caps in a range. In 2020 and 2021, a lot of you came into the market trading small caps first before anything else because small caps tend to move a lot when the markets are hot. Over the last 2.5 years, the markets have not been hot for small caps for longer than a week or two. It has been a very tough time to trade small caps. A lot of you guys have come over to options trading because you seek the same thrill. Guess what happens for options when the market doesn't move very much? Unless you're selling premium, you're getting crushed by VIX or Theta. So welcome. It's the same game. You're just trading a different financial instrument. Be patient. IWM above 200 is greenlit to still go long in certain sectors that are showing outperformance. We realistically want to see IWM break above 220 and head towards that 255 price target. Think it's going to happen, just a matter of time. Here's your mid cap, right? Mid caps outperformed a lot last year, particularly October, November, December, and into this year, January and February, before starting to find some resistance at previous cycle highs at 535. We broke out into all-time highs. Matter of fact, a week and a half ago, this was at all-time highs. And here we are pulling back once again. It's the end of the world because line goes down for 2 weeks instead of up. I understand. But as long as we're holding 535, price target 618, mid caps are greenlit. We fall back below 535, we're not buying any more mid caps. It's really that simple. It's not easy, but it's simple. Draw a line in the sand. Above it, good. Below it, bad. Mid caps still look good here. Here's your Dow Jones, by the way. Has there think about this. Has there ever been a time in the market where the Dow Jones Industrial Average closed at an all-time high, and then the very next day, the market was supposed to fall out into new bear market lows? People are insane. The Dow Jones Industrial Average closed at all-time highs last Friday. All-time highs, guys. And that's including Intel, the worst performing stock and one of the worst performing stocks in the S&P 500. There's not a lot of stocks in the Dow Jones Industrial Average, so this big legger is pulling down the DJIA a lot, and yet we are still at all-time highs. Once again, remove yourself from the crazy pessimistic BS you see every day and look at the charts. Is it really that bad? Finding resistance at the 41K area. I don't see any reason why the Dow can't flip that and start its advance up to the 48. It sounds ridiculous, but I want to tell you something. When we broke above 36 and we had a price target above 40, that sounded ridiculous, and here we are. Here we are. We're now trading in the 40s. Do we find resistance here? Probably, just like every other chart we've looked at. These fib levels give us a general understanding that, hey, price is going to consolidate here before going higher. What happens to stocks if the Dow Jones continues to break out here within the next few weeks? You're probably going to get paid if you're long. The Dow Jones Transportation Average working on completing a massive base to the upside. 110, 120 years ago, Mr. Charles Dow, the creator of these averages themselves, the industrial and the transportation, said when these things are moving in the same direction, up or down, the market is efficient. You want to be max long in uptrends or cash in downtrends. At the time, I wasn't shorting. He wasn't shorting the market, so he was in cash. The Dow Jones, almost a 3-year base, looking to complete above the 16.7K range. If that happens, my money is going to be that this bull market continues to scream higher. Very rarely do you see these indexes moving in the same direction and stocks are not rapidly appreciating. I'm waiting for it. We've been waiting for it for a while, though. At every bear's dismay here, we talk about this in TTI all the time. Market breadth is going up. It sucks if you're bearish. Absolutely. It doesn't make any sense. If you think this market's rolling over, tell me why there's more net highs than lows. Sorry. For a bear market to really start, you got to have broad-based degradation of stocks. Yes, the Mag 7 stocks are lagging. We can see that. We can point to it. We don't have to trade those, though. We can trade other names. Net highs are improving during this summer volatility. The data is right there. Look at it. Green bar, good. More stocks are going up than down on the weekly. Volatility is back. Let's see here. Volatility back to decade average under 20s, right? So I drew a line there at the 20 area just to show you, we talk through this inside of TTI often. Below 20 is really where you want to be buying lots of call options, particularly in a bull market, because typically implied volatility on those contracts is going to be rather low, and the odds of you getting IB crushed are a lot lower. Not always, but a lot lower. Above 20, which our intern Randy had pointed out earlier today, you might want to start to get a little bit cautious about buying call options above that 20 area. And then if you have some crazy 60 area like we saw, which was the largest single daily spike ever, by the way, this is going in the history books that it reverted in like 2 days. If you were buying call options or put options up here, you got crushed no matter what happened. You do not buy typically when you're way up here, but above 20 is kind of that threshold. So be careful if you're buying straight calls or puts. Spreads are a little different, or if you're playing premium, that's fine too. Under 20 is really what we're going for right now. We're trading at around 21. Stocks above the 20, 50, and 200-day moving averages. Once again, market breadth, not bad. Stocks above the 20-day moving average in the S&P 500, 71. Stocks above the 50-day moving average, 69. Stocks above the 200-day moving average, 71. These are percentages. So you're telling me a majority of the S&P 500 is trading north of the short-term 20-day moving average, north of the intermediate-term 50-day moving average, and north of the 200-day moving average, which is the long-term trend. Once again, guys, you can hate this market all you want for not dying, but until you see these lines go down, a majority of the market is not participating in any sort of rollover. So that's probably why you're not getting paid out 10-1 on puts right now, unless it was NVIDIA or some crazy semiconductor high beta play. The index is not getting crushed as much as people expect because most of the constituents are not getting crushed with it. Put to call ratio spiked last week. We're back up to 1. We'd really like to see this put to call ratio spike up towards that 130 area because that typically starts to signal a potential bottom and a squeeze back to the upside. So we're back to the median there at around 1, that neutral area. We're heading back up, though. We came back down into oversold territory. If that's how you want to read it now, we're going to look for the overbought territory, which means we could be here for probably another week, 2 weeks of this choppy volatility. Typically, I will tell you this wasn't highlighted earlier in the seasonality portion, but the last 2 weeks of September are typically going to be weaker than the first 2 weeks. So just keep that in mind. Look at that put to call ratio. When we get up to that 1.3 area, the opportunity for a squeeze to the upside really gets a lot higher. High beta stocks have not really done a whole lot since the July peak. They're still chopping sideways. We're holding previous cycle highs, which is nice. But when we're looking at new stocks to trade, remember, we want to own strength here. And there's not a lot of strength in these high beta stocks. They're not necessarily going down, they're chopping around. So we don't necessarily want to keep buying these unless there's a clear trend to the upside. And could it be any clearer that lower volatility stocks don't give a shit about what's going on with higher beta stocks? These guys are breaking out into all-time highs. Low volatility stocks, to every trader's dismay, are the areas of the market that are working. The financials, the healthcares, the utilities, the consumer staples, the materials, the industrials, the boring shit nobody wants to own is exactly what the market is buying. You can fight that trend all you want. You're going to live a very uncomfortable life in the market, though. As a matter of fact, if we look at SPHB against SPLV, basic ratio chart, tell me, if we're back within this range, do you really want to be buying those higher beta stocks over lower volatility stocks? No. And by the way, we have traders inside of TTI that are like, listen, wake me up when high beta comes back. I don't want to live through this low volatility market regime. Totally fine. But if you're buying high beta stuff, expecting some quick turnarounds, everything is telling you that you're going to have a tough time. All right? Going to look at a couple intra-market relationships here. My favorite, consumer discretionary against consumer staples. I will give bears one thing here. There's not a whole lot to give bears this year, but I will give bears one thing. You typically don't see consumer discretionary roll over in a bull market. So, we are not so bulled up that we are blind. We look at 50-day lows and breakdowns all the time. As a matter of fact, I think tomorrow the report that's going out is our Bear Tracks report, which is looking at the weakest stocks in the market. Because, guys, it's September, and while I'm bulled up, there's never a 100% chance of anything other than you're going to get fucked a couple times in the market and have to pay taxes. Those are the only two real 100% things. But this is not a relationship that is very common in a bull market. You're seeing consumer discretionary underperform against consumer staples. So you're looking at, your Teslas, your Fords, your General Motors, your cruise lines, resorts, hotels, Amazon, basically anything that if you have a couple bucks, what are you going to go buy? All right, you have a couple extra bucks, where are you going to go spend it? The consumer staples are going to be names that, hey, you don't have a couple bucks. Maybe, you're pinching pennies or whatever. What are you going to buy? Things like, well, Coca-Cola, you're probably going to continue to buy even if you don't have a lot of money. Maybe your Walmarts, you're not going to be shopping at Trader Joe's anymore. You're going to Walmart's type stuff, right? So when you see this relationship start to roll over here, this is one of those things that piques my interest. Why is that happening? Is this normal for a bull market? It's not normal. So yes, this is a win for the bear side of the regime here, and we are constantly watching that. That could be a very good precursor to what might happen. Who knows? Another one, high yield corporate debt against treasuries. We're still holding those previous cycle highs there, that range high, back in 2022 to 2023. I'm not necessarily worried about the interim downtrend here. This thing is goes up and down all the time. As long as the trend is still up here, the bull market should be intact. What we're looking at are, the smart money, Are they buying high yield corporate debt, which is higher risk, higher reward? Or are they going out and buying the longer dated, relatively safer, lower reward treasuries in a bull market that is inundated with risk, where people are really taking risks? Generally speaking, you're going to see high yield corporate debt outperform. And we have seen that over the last year and a half. So it continues to show there. And the last one, stocks versus shiny rocks, which you're going to look at in a second. Is there an edge in owning stocks over gold? Most people would say, yeah, own stocks over gold. And then you have Peter Schiff in the background screaming, you got to own gold. You got to own gold. Well, to Peter Schiff's credit, actually, SPY and gold have performed relatively the same over the last 4 years. Two different paths, same destination. That's not normal, given the fact that we've just traded through a deflationary regime where stocks greatly outperformed gold. But if you're unaware, I'm not going to get into it, but if you're in TTI, you got the spiel again yesterday. We have moved into an inflationary regime, which means just inflation forces are stronger than deflationary forces. And actually, SPY or stocks in general and gold tend to move relatively in the same direction under those types of market regimes. So doesn't necessarily surprise me to see SPY and gold track relatively the same. As a matter of fact, we have a gold position on and it's working very well. We're going to go through that at the end. All country, right? You're going to see a couple countries here. These are all-time highs for stock markets around the world. That's all I got to say. It's not just the United States participating in this bull market. We have lots of different countries around the world, but one that is not participating is the Chinese market. Guys, China is uninvestable, untradable. Other than a temporary mental setback of mine in May of this year, we have avoided Chinese stocks for the greater part of the last 2 years. We have not given the CCP any of our goddamn money, except for a couple stupid trades in May. We took a little bit of a risk there. And guess what? Just like every other time over the last 2+ years, Chinese stocks have burned everybody trying to buy these things. We don't want to own these things until we're above 33.5. I don't care how good PDD looks. We are trading based off of sector strength, and sector strength is not apparent in Chinese equities. Here's your emerging markets, which includes China. I want you to look at it. We're holding that range high there at the 42. It's still green lit from an emerging market standpoint. This is including China. Let's see what happens if you exclude China. Wow. The world looks pretty goddamn good, actually. We're pressing up in towards potential all-time highs without China. China is a huge lagger on the world stage. I'm not a hater of China, but I'm a hater of Chinese stocks, and I've been a hater of Chinese stocks for the last 2+ years for good reason. They suck. They do not work. Avoid them until they start showing strength. A majority of the world is in a bull market. Don't believe me? This is year to date. Go back 1 year. Go back 3 years. Majority of the market is performing very well. You want to know what's not performing well? China, South Korea, Hong Kong, Mexico, Brazil. Unfortunately, I'm living there. But look at the rest. Europe looks great. Half of Asia looks great. Half of the Americas, look great. Middle East and Africa look great. Lots of different areas of the market look good. So let's talk about that market breadth really quick, and then we're going to get into some individual trade ideas here. Equal weighted S&P 500 last week, all-time highs. You're going to have a really tough time convincing somebody with greater than 85 IQ points that the market is weak when you have an equal weighted S&P 500 ETF closing at all-time highs 2 days ago. Like, come on, guys. Every single stock is relatively weighted the same. That means Apple is going to be weighted the exact same as the 437th stock in the S&P 500, right? For those of you that don't know, the S&P 500 is not equal weighted. So the big boys at the top are going to influence more. When Mag 7 starts to lag, the S&P 500 is going to be volatile and potentially pull back. RSP doesn't have that problem, right? So broad market is participating well into this bull run. QQEW is a change, though. Or chopping around those previous cycle highs at 121. Has not had the same type of success as some of the lower volatility areas in the market. We're seeing some underperformance in internet stocks. We're seeing some underperformance in software stocks. It's not necessarily ready to roll over into new lows, but I'm more of looking at this as when it continues its uptrend, which I do think it will, because I think tech is going to continue here. I would expect this particular part of the market, right, the equal weighted Qs, to give us a clue as we break above the 128 area and head up towards that 145 price target. Now, these are equal weighted ETFs. We're not trading them. We're just using them as analytical tools. But this will allow us to understand where the strength and opportunity cost lies. If you own a bunch of these QQQ names right now, they might work 6 months from now, 12 months from now, but you're going to be holding them at a loss probably for the next couple of months before they start to kick back up. Meanwhile, we could own some lower volatility stocks. In the meantime, close those at whatever price targets we hit, roll that profit in to the lagging QQQ names, and then we'll take the benefits of the high beta stocks as they break out. That's the tentative plan here, and we can see it playing out across multiple charts. Bonds. If you were here 2 weeks ago, we put a bond trade on. Who was here 2 weeks ago to put the March on? Because it's working. We have 2 tranches of trades on TLT. We have a January $100 call, which is up about 50%, and we have some March 105s, and some March 110s, depending on how far or how much you want to pay. All 3 of those are working right now. There is a positive bullish divergence, or positive bullish momentum, on the TLT chart. Bonds are bottoming. That is my call. We are long. It is working. We were joking around inside of the Discord earlier today in our community, and we were saying, you know what? How cool is it going to be able to tell our friends and family that we bought generational low bonds? That's a cool story. It's almost as cool as saying you bought oil when it went negative $20 a barrel. That's a cool story, one for the history books. This has been one of the deepest and longest recessions, shouldn't call it a recession, a bear market in TLT's history, in bond market history. And we could potentially be buying the bottom. I think that's pretty cool. Plus, these trades are going to be profitable, which is even better. And if you don't believe me that I think bonds are bottoming out and offer good R to R here, risk to reward, and I think for people that are not afraid to own these things for some time, you could make some pretty decent cash here. Here are yields. All right, yields are inversely correlated to bonds. Yields in all flavors, completing topping patterns. If these were stocks, we would be shorting them, right? You have the 1 year, you have the 2 year, you have the 10 year, you have the 30 year. Yields are topping. What does that mean for bonds? Well, the exact opposite. Bonds in all flavors are completing bottoming patterns. Understand, yields come down, bonds go up, makes total sense, right? Got the 1 to 3 year ETF on the upper left-hand quadrant, that is SHY. You have your 7 to 10 year ETF, that is your IEF. You have your 20 plus year, which is the long-term bonds, your TLT, and you have high yield corporate bond debt, which is what we talked about earlier in the intramarket analysis, and that is HYG. All 4 of these are completing bottoming patterns. Once again, yields topping, bonds bottoming. Hey man, throw it on the books. Go out there, buy some March 2025s and forget about them for 6 months and see what happens. We're doing it. We like it. I asked our intern Randy to submit a couple charts that he thought would help people that are struggling, and he goes, hey, pullbacks are normal in uptrends. I totally agree. Totally agree. He highlighted that summer pullback in 2023. He's looking at this current summer pullback right now. Right, there are some similarities here. For people that struggle holding strong stocks and uptrends during any market pullback, understand that there are only 2 types of people in this world that time every top and buy every bottom. Marketers and liars. Most of us have 9-to-5 jobs or own a company. We don't get to lie or market our way to incredible profits. We have to simply hold through some of this stuff with the understanding that uptrends tend to continue to persist until something really big happens in the market. If you don't know what that sounds like, go watch the distribution webinar that's public on YouTube I put out about 4 weeks ago. These are normal pullbacks and uptrends until proven otherwise. The other chart that he sent was, now is the time to monitor for relative strength. November, December are a whole lot better than the summer months, which we went through during the seasonality portion. But he's right? We're going to touch upon this towards the very end. This is the time to be building out your relative strength watch list. Look for the stocks that are outperforming the benchmark. So if SPY ends up drawing down another 10%, which Mr. Famous Tom Lee said could happen over the next 4 weeks, look for the stocks, particularly the bigger stocks, large caps, mega caps, that don't draw down 10%. There's your relative strength, and those are typically going to be the names that lead through the winter months, right? So let's go ahead and move into some of the exposure data here. CTAs, we love CTAs because they're just some of the dumbest people. Actually, they're very intelligent people. I apologize. These are the professional money managers. So if your parents have money locked up with a financial advisor or some sort of firm, these are your CTAs, and they're notorious for playing catch up. They have to be exposed because clients harp at them. Last year, we saw all-time highs, and CTAs were criminally underexposed. So guess what happened late December, early January, when they had to send out their yearly reports? They had to buy all-time highs. And then what happened for the next 4 weeks? The stock market consolidated and lots of stocks pulled back, and they looked like assholes. It's probably not going to change. We love CTAs. And my last dig at them, how many of these guys do you think are on Twitter giving their opinion? They are underexposed once again. They bought the dip hand over feet and are once again being probably hurt by this recent market pullback. We'll see where we're at in 2 weeks with CTA levels. It's a hell of a job. I worked as a professional money manager for a number of years, and I'm very glad that I don't have to talk to clients anymore. Instead, I can just talk to you guys in Discord, because when you guys are being little bitches, I can say, stop being a little bitch. Can't do that in a professional capacity. Man, sometimes I wanted to say it though. Commercial traders still net short or hedged. This is your COT report, but they are decreasing, right? They were greater hedged in the early summer months. They are decreasing, but still hedged, still net short. And leveraged funds are now hedged, right? So they're moving in. They felt the volatility of that August 5th. You can see that they're loading up some shorts here to get hedged. They don't want to be caught long in a market that might be choppy through September and potentially October as well. They're not net short, as in looking for huge moves to the downside. They are hedged. We will continue to track that. It's a couple of days old, August 27th. We'll continue to track that. When we see commercial traders take those hedges off, guys, that probably the market is starting to swing back to the upside. So we take that information seriously, because obviously commercial traders are the smart traders. Those are the guys that everybody supposedly wants to trade with, the financial institutions, privy to better information, etc. And thankfully to the COT report, we can see how they're positioned in the market. Little tongue in cheek here. Remember when they told us the consumer is weak? We talked about this 2 weeks ago, and I showed you Walmart, Uber, Ferrari, like all these consumer-based stocks at all-time highs. Well, how about Dollar Tree and Dollar General? If you were trading these earlier this week or last week, if you're day trading them in particular, these were fantastic opportunities to take a stock down into some seasonally weak price action. I want to point out that the core consumer here makes less than $30. I think I messed that. I think I wrote greater than. That's okay. They make less than 30,000, and so we don't get into earnings here, at least on these webinars. But the Dollar Tree and Dollar General earnings reports basically are saying that the consumer at the impoverished end of the spectrum is really starting to hurt. How difficult do you think it is to trade when you're reading headlines like that, and then you have Walmart and Costco screaming up at all-time highs post earnings? So the reason why I put this in here is not necessarily to harp on Dollar General, Dollar Tree, or people that make less than 30, or to speak up Walmart or Costco. It's to prove to you that if you're trading based off of headlines alone, if you were to read Dollar Tree's earnings report says consumers or households making less than 30,000 can't afford products, first thing you think of is, holy shit, this economy sucks. Dollar General said the same thing. Holy smokes, are you kidding me? And then you go over to Walmart and Costco and they go, we see no material degradation whatsoever in our core consumer. And you're like, well, all right. I thought the economy sucked, but now you have Walmart and Costco at all-time highs. It can make anybody go crazy. Don't trade headlines, trade trends, okay? Don't trade headlines, trade trends. This was a previous chart that I should have taken out. That was Dick's Sporting Good at all-time highs, which it still is, by the way. Okay, new themes. Here we go. Trade ideas. So if you only care about the trade ideas here, this is your portion. We have about 20 minutes to get through these. New themes emerging. All-time high sector breakouts. Guys, if you're not aware, the market is more than just tech, consumer discretionary communications. I've tried to make that abundantly clear as I go through these trade ideas. Here you go. 6 flavors of sectors, all breaking out into all-time highs. Consumer staples, healthcare, industrials, utilities, financials, materials, communications, an honorable shout out. Let's look through some consumer staples names first. There is your consumer staples XLP ETF on the weekly. Doesn't look too shabby after a 2+ year range breakout into new highs. Not bad. We don't have a trade on that, but we do have a trade on a couple of these. Colgate Palmolive went out a long time ago in one of our heavy hitters report. I doubt anybody owns it, which is fine, but I added this chart to highlight something. It might be an AI bubble. I'm not here to refute that, but what about a toothpaste bubble? Right? This is insane. You could have bought this at 86 and you've owned it at 108, and this has basically been a straight move to the upside. Now, I'm not saying that if you missed this, you're an idiot, because I'm not in it. Or maybe I'm an idiot. I don't know. But these types of charts exist outside of tech, right? So open your horizon a little bit. Understand that lower volatility takes a little bit longer to get moving. You can find charts like this. Colgate Palmolive, a bubble in toothpaste. Clorox. This is a stage 1 setting up into a stage 2. Who would have wanted to be buying Clorox? This is not a trade you want to go tell your buddies in group chat. I just bought a bunch of Clorox. They're going to go, please don't kill yourself, Rick. No, I bought the stock. Above 168, we want to own it to $200. This is a stage 1 into a stage 2, right? Bullish momentum regime going back to June. Price is trading north of the 200-day moving average. This is sloped up. We have a very obvious risk on level at 168. We're not there yet, so wait for that close above 168. We're targeting the $200 range. Options are available. I'm not adding the options here because I'm going to keep them just for the members. If you're interested, the link is above. You can pay. If not, I put out occasional trade ideas on Twitter as well with the options contracts appended to those. So feel free to follow me at How to Swing Trade. Coca-Cola, here's a trade that we're in, right? Everybody that's in this trade in TTI, it's a free trade. It's up anywhere between 150 to 200%. All-time high today. We bought it off the 67.15 breakout. Once again, no trade here. About 65 to 70% of the way through to the price target. But just going to show you, right? Colgate, Clorox, Coca-Cola, not trades that typically people want to take. Upward sloping 200-day moving average, bullish momentum regime on the RSI, and up into big blue skies. Take the trades, take the breakouts, guys. Altria Group. This is a tobacco company, if I'm not mistaken. Stage 1 into a stage 2. Bullish momentum regime for the most part of the last 2 quarters. Upward sloping 200-day moving average. If you get sick of me saying this shit, it's because nearly every single setup is going to be the same because they work. We've been buying them for 18 months and we've made money on a lot of them. So buy these. Once again, probably not going to get a 1,000% move in a week like most people are expecting, but these things are typically stocks that are not going to gap down 50% overnight either and destroy you. Just buy some time if you're going out with contracts. And if it's shares, set the expectation this trade's going to take like 4 to 6 months, and that's fine. Buy it above 55, target 69, 75, 70 bucks on the dot. We'll see where we're at when we're about halfway through that. This is a good little opportunity to own a tobacco stock. Here's one we just opened up. You have an opportunity to own it with us because we're not up very much right now. Philip Morris. Another tobacco stock. Like I said on Twitter a couple days ago, I think it was yesterday I posted it. I don't know if smoking's cool again. I don't smoke. If you can't tell, I have asthma and allergies because I live in Brazil. I can't even look at a cigarette without wanting to fucking die. So I have no idea what's going on with the whole smoking scene, the Zins, the vapes. I don't get it. But I do know that above 123.5 of Philip Morris, we're targeting 165.50. And that is a 7-year base breakout. In my part of the world, bigger the base, bigger the breakout. 7 years is pretty goddamn big. Bullish momentum regime going back all the way to basically the beginning of 2024. Upward sloping 200-day moving average and big blue skies. The only thing you have to worry about is the asshole selling after you. There are no previous buyers up here. It's big blue skies. We love these types of opportunities. This is a great call option opportunity. We bought straight calls on this. When you find a low IV name into a big blue sky setup, buy the calls as long as they fit your 1R, your risk level, right? Healthcare sector, all-time highs. Once again, not the sexiest sector to be trading, but there we go. Wasn't an easy breakout either. We have been long healthcare on and off over the last year. We're long again. It's working for us. Hasn't been the easiest trade, but here we are. All-time high in healthcare. United Health Group, this is the largest stock in the Dow, if I'm not mistaken. So the Dow that was just sitting at all-time highs on Friday, well, guess what? United Health is also at all-time highs. That shouldn't be a big surprise, guys. We had a 595 range breakout, targeting the 620 to 625 price target. We do have a couple people in this trade inside of the Discord. It's working very well for them, up and over 100%. Congrats to those of you that grabbed UNH. No entry here until we consolidate underneath 6225-ish, right? That 625 area. That Fibonacci extension up there will offer a new opportunity to add in for those of us that missed it, myself included. And we're going to go out there targeting north of 700. So an opportunity very soon here on that United Health. This is the leading healthcare stock, second largest market cap. I believe Eli Lilly has eclipsed it, but the most important component of the Dow, Mankind. We have this trade on the books. It's up right now for us, not by a whole lot though. So an opportunity for you if you'd like this type of range breakout, right? This is not an all-time high, I believe, but I think it's like a decade high or something. So essentially a big blue sky, unless you want to assume somebody 10 years ago bought some shares and they're still pissed off and they want to offload it for break even. Probably not, but maybe. 200-day moving average sloped up within a bullish momentum regime all year. Really a nice stock here, right? We want to target anything near 775 to $8. We want to own it above 575, currently trading 611. So any sort of weakness that comes in, if you want to own that with us, feel free. We really like this setup. These range highs really have performed well for us for the last 18 months. Here's another stage 1 into stage 2. A lot of these are showing up. We were trading these in January and February of 2023, and they ended up being some of the biggest gains we made in 2023. 2024 hasn't had a whole lot of these stage 1 into stage 2s because most of the stocks that were leading the market had already completed these stage 1 and stage 2s. Well, now we have an area of the market that hasn't yet performed up to its standard, right? Healthcare just breaking out into all-time highs, just joining the bull market. And now we have, of course, all of these stocks looking to complete their stage 1 into stage 2s. We're expecting most of these, well, let's be honest, we're expecting all of these stage 1s to break out and start a stage 2 advance. That's why we want to own them. Trading north of a upward slope 200-day moving average. This is not a bullish momentum regime yet. We have yet to oscillate down towards that 50, but RSI is above the 50, which means it's greenlit to own. 91 and above, we want to own it to 104.5. There's a low volume gap that you can see on the right, that VRVP. So we are not expecting a whole lot of resistance on the way up. We look at this as an opportunity to own a potential healthcare stock through a volume gap, which tends to have a violent move to the upside. So if you're looking at calls there, I did not check the options chain on this. If the IV is relatively low, this is an opportunity to own straight calls depending on your own risk as well, right? Don't go out and lever up your account on stuff like this. But calls here are a great opportunity to take advantage of an IV, a potential IV expansion on the breakout. So Medtronic on the daily. Let's look at some industrial names. And by the way, Dow Jones Industrial, the industrial sector, the DAX, by the way, the German stock exchange, you superimpose these charts, they look basically the same. The German DAX, I think, is comprised 65 or 70% of industrial-related stocks. So it shouldn't be a surprise to see that this sector breaking out. All of the other areas of the market that vibe with industrials are also breaking out. So all-time high with industrials. Now, industrials is a little bit of a harder sector to trade because it's a grab bag. Sector in of itself holds a lot of different industry groups. You can everything from ADP, by the way, which is like a professional services, to logistics and trucking. You have airlines, you have railroads, you have Uber, lots of different types of stocks, aerospace and defense. You have Raytheon, lots of different types of stocks in this. So when industrials are breaking out, generally, at least old school type of traders will look at that as a broad-based market breakout as well, because there's so many different industry groups participating. ADP is the next big large cap breaking out into new highs. Want to own it above 270, currently trading 275. You haven't really missed it if you want to own it. 310 is the price target. We want to own it as long as it's staying above the 270 pivot. We did buy options on this. I don't remember exactly. I think we bought the $300 January calls, if I'm not mistaken. And it's doing all right? We're not down on this trade very much, if at all, depending on where you got an entry here. But as long as we're holding 270, we're looking for that 310 area move for ADP. Who would have expected ADP? Not me. Not in a million years. I thought that company was dying, but here we go. ADP rules the world, apparently, in that part of the world. Union Pacific Corporation, for those of you that like owning logistics companies, I don't know why, but that's okay. Railroads. Why? Why not own railroads? Union Pacific on the daily above 255. Target all-time high $300 area. Remember we were talking about the Dow Jones Transportation Average? We're expecting that to resolve higher. It's been building a base since 2021. Well, so has Union Pacific Corporation. And we're finally pressing in towards those highs. Above 255, target 300. We are in a bullish momentum regime and in somewhat of a big blue sky environment. Obviously, we did trade back here previously, but if you look over at the right-hand side of the chart, there's not a whole lot of volume up there. So we use this as an opportunity to view, what are the odds that the path of least resistance is not higher? It's very low. There weren't a whole lot of shares exchanged back up here in late 2021, early 2022. So we like this trade for a big blue sky setup. If calls fit your risk above an upward sloping 200 moving average and in a bullish momentum regime, you can own a couple calls in UNP. Let's look at financials, which is my favorite sector right now. This has been my highest performing sector this year. I've made more money trading financial stocks this year than tech stocks. That's just the way it goes sometimes. I had no idea when I put the JP Morgan trade on in January that I was going to make as much as I did. And to all of my glorious haters on Twitter and YouTube that told me JP Morgan sucked and the market was going to roll over, once again, I'm glad I don't listen to absolutely anything you say, respectfully. Insurance. Who had insurance up? All right, we talked about insurance. Second best performing industry group this year. And we have 4 major insurance providers up at all-time highs. We have Aflac, Progressive, MetLife, and Travelers. Once again, not the sexiest area of the market to trade. But these are the areas of the market that are performing well. So if you're looking to put a trade on that's lower volatility, these are probably not terrible areas to start looking at. Look at that Progressive chart. Look at that Aflac chart. We had a trade idea out for Progressive back at the 155 pivot. It's currently trading 253. Once again, you tell your boys in group chat or your gals that that you buying Progressive, they're going to go, what the hell are you doing? I thought you had car insurance. And you're going to go, I'm talking about the stock. It's up almost 100%. Travelers, there is an opportunity to own this. After consolidating for a majority of 2024, it does look like it wants to continue its breakout here. Nice little rounded bottom into a continuation fractal. Excuse me. We're targeting 280. Right, we want to be long above the 232 area, targeting 280. Probably a better shares trade, by the way, than a options trade. But if you go through the options chain and you find something with liquidity, the problem with these insurance companies on an options basis is there's just not a lot of volume and open interest in some of them. Progressive and Aflac have it because the goddamn charts are parabolic. But buying it back here was difficult. It was very hard to go out and buy that stuff because there was nobody interested at the time. But isn't that how stuff goes? FOMO. When stocks go parabolic, all of a sudden everybody wants to own this stuff. Travelers is probably going to be in that realm as well. Not a whole lot of open interest in volume, but I encourage you to go check yourself. Still a nice breakout above 232, targeting 280. Continuation play off Travelers and insurance once again working well. This is a trade we put on last week, sent out in a newsletter as well. Bank of New York Mellon, working well for us above 64.5. We have a price target up there at $80. I believe we bought January's, if I'm not mistaken. January's or March's of next year. So we're going out there. We expect this to take a little bit longer, but a nice 2-year range breakout high. And also, if you go back, scroll all the way back 10 plus years, you'll realize that we're breaking out into a decade plus high as well. So that's fun. Little confluence there with the Bank of New York Mellon. I love financials. These stocks tend to just continue to work this year, and so I'm going to continue to own them while they're working. Bank of Mellon once again. Good opportunity, bullish momentum regime, etc. Bank of Nova Scotia completing a potential stage 1 into stage 2. All I hear about is Canadian stocks suck. And here you got a Bank of Nova Scotia pressing up against previous resistance up there at 51. If it flips 51, there's an opportunity to own this up to 57.80. And this does have options availability. We have a guy inside of the Discord right now that was like, hey, I'm long Bank of Nova Scotia, and he's up over 100%. So we're looking to get long as a community above 51, targeting 57.50, 58, something like that. It's only a $6 move, but obviously the percentage there makes it attractive. 200-day moving average sloped up or within a bullish momentum regime, opportunity there for Bank of Nova Scotia. Intercontinental Exchange, not something we can own here, but there was a trade idea out in a heavy hitters report, 139.50. Just showing you guys that, right, once again, nobody wants to own this stuff until you flip through these charts and you're like, holy shit, I wish I bought it when I looked at it. Myself included, I don't own ICE, but I'm just trying to build rapport here with different types of stocks. You don't need to go and own tech stocks. There's plenty of opportunities out there across the board in different sectors. MasterCard is a stock we do want to own. We owned MasterCard earlier. It worked okay for us. We owned Visa. It worked okay for us. We have the same kind of idea. It's going to work probably okay for us from an option standpoint, just a lot slower mover. Like I'm telling you guys from personal experience, the trade worked. We hit our price target. It was not the most enjoyable trade. Having said that, if you want large cap exposure in financials, which is increasingly harder to find, JP Morgan is not really pulling back, KKR, etc. MasterCard is giving you a new risk on level. We want to own this above 485, price target north of $500. Options contracts are out there. The MasterCard and the Visa trade both liquid on the chain. It's going to be expensive, so call debit spread this if you need to bring that cost down, but a nice continuation play. And by the way, another dig at the consumer apparently in the United States is going down. MasterCard and Visa's entire goddamn business model is based off of consumers swiping their cards. So tell me why this stock is going up if we aren't spending money anymore, right? It just doesn't make sense. Trade the charts, not the headlines. MasterCard, once again, a continuation fractal above 485, targeting 575. Materials sector, another area of the market. Very few people want to trade. I understand it, but guess what? All-time highs materials. Here's Sherwin-Williams, a paint company. I'm sure everybody has heard of this. Above 353, targeting 450, 451, currently trading 362. Not the easiest options trade to take. Options chain is a little illiquid, but if you find something, you can make it work. Not a bad little risk to return here. This is also a pretty good shares trade. Slower moving. Set the expectation this might take 4 to 6 months, maybe a little longer, but it's a high R to R trade. You're long above 350, 350 with the stop right underneath that proprietary gray box and the stop out or take profit, all the way up at 450. This is like an 8 to 10 to 1 setup. So, you can hate owning lower volatility stocks. You don't even got to like painting companies. I don't know. People don't like Sherwin-Williams. They like a different type of paint. The stock chart is amazing. We like it. We want to own it. Lind, chemical company, right? Same type of setup as MasterCard. It's a continuation fractal after about a 7 to 8 month consolidation range. We want to own this above 481, which is that fib target. And where do you think the next price target is? 565. You don't got to make it any more complicated than that. Nice upward sloping 200-day moving average price has tracked that all year. We've re-entered a bullish momentum regime going back the last couple of months. We like Lind above on a continuation play, 481, targeting 565. That is an options playable name. Granite Construction, we opened up as a community 2 weeks ago. It's working. It's slow. It's working. This is a cement in a home construction based company. Still an opportunity for you if you want to own this for shares. The options contracts are slow, not moving as much as we would have hoped, but the shares trade is working well. We want to own it above 68 with the price target up near 104.5 or 105. Once again, this is a high risk to reward setup like the Sherwin-Williams. It's going to take a little bit longer, but this is a 7 to 8 to 1 setup. So risking $1 to make 8 up at that price target. Not a bad idea for those of you that are okay with sitting in stuff a little bit longer. Real estate. We took this trade 2 weeks ago. You guys took it if you were here. This was in the public webinar as well. We bought those $45 calls, and those are up. Oops, let's go back really quick. Those are up right now. So we got $45 calls. We're looking for a $48 price target. Whether you want to, say that real estate's up because interest rates are coming down in September and that's bullish for real estate, be my guest. I don't care. The only thing I care about is this was a stage 1 into a stage 2 breakout above 42. Paint whatever narrative you need. I'm making money on the calls because I bought it above the imaginary line, and we're going to continue to own those. Once again, a good opportunity to own a stock in a low IV environment, breaking out into a 2-year high. That's when you really want to try to grab those calls if they fit your risk. Call debit spreads are fine if it's too expensive, but calls are generally going to be preferable in low IV environments because you're going to make money 2 different ways. The directional move and implied volatility obviously expanding. So we're in a bunch of these stocks right now that are breaking out that most people either don't even know are available or they're like, oh, these things are boring. I don't want to trade that. We will. Absolutely we will. And we're getting paid by owning some of these lower volatility consumer staples, real estate stocks, right? American Health REIT. This is in our Big Blue Skies scanner. I'm only showing you this. Nobody in the group, including myself, owned this. We own a different stock that looks relatively the same within the same industry group. But there's a lot of pushback when I post some of these types of setups on social media that they don't feel comfortable buying these IPOs. I understand that from a certain perspective, particularly if you started trading in 2020 or 2021 because you were buying the tops of IPOs. But these IPOs going back 2 to 3 years for the most part have gone through complete market cycles already. They've gone through stage 3, stage 4, and stage 1 into stage 2. AHR is hitting a market where we're in the middle of a bull market right now. These types of Big Blue Sky setups are being introduced in the middle of a bull market. You're not buying these at those 2021 highs anymore. You're buying these when risk is getting actively pushed into the market. Own them as they break above their IPO range highs and look at how friggin' crazy they are, right? I think the biggest, most recent and largest Big Blue Sky trade that we put on that it net us 2,000 to 3,000%, not over exaggerating, was ARM, ARM. We bought it in November of last year. Go look at the chart. We held it through every single gap up. It was a 2,000 to 3,000% winner, relatively the same setup as this. Not saying AHR is going to be that type of setup, but once again, for those of you that are always like, I don't know, take a couple bucks, throw it at these charts. The beauty is you're in the middle of a bull market. And for those of you that know a little bit about economics, price equilibrium is nowhere to be found. Nobody knows what this goddamn thing should be worth. And that is a potential gold mine for a technical trader that follows breakouts, momentum, and trends, right? There is no real price target here. We love that stuff. American Tower into a stage, or in stage 1 into a stage 2. Another REIT. This is a little bit harder of an area to be owning from an option standpoint because the liquidity on the chain can be poor. So I tried to go through, and off the top of my head, because I've been trading these for so long, I know American Tower has liquidity on the chain. This is a very normal chart pattern where you cut the stage in half. You see the stage cycles here, uptrend, distribution, downtrend, stage 1 into a stage 2. This is, we want to own it above 232 and target 280. An opportunity to own this from an option standpoint and a share standpoint. Bullish momentum regime, upward sloping 2-day moving average. We like American Tower for some real estate exposure. This is another chart that's totally fine. This is going to be a little harder to own from an option standpoint, but from a share standpoint, it's a high R to R trade, just like Sherwin-Williams and CVA and everything else. Own it above 111, price target 140. Stop out below the proprietary gray box. This is about a 5 to 1 setup right now, but also just want to point this out. Commercial real estate is supposed to blow up, and yet CBRE, which is obviously the poster child of commercial real estate, these are all-time highs, folks. So whether or not this commercial real estate bubble exists or is going to implode, I don't care. It probably will. But for the meantime, we're going to own the stock because it's going up. You can make a lot of money in bubbles if you catch the right side of the bubble. Home construction, just to kind of extrapolate off that idea, last week went out at all-time highs. Home construction slowing down, that's real. That's a fact. We can see it in the data, and yet the stocks continue to push higher. So if you're trading based off of the headlines, you're going to get steamrolled over. So home construction, and there's a slew of home construction names. I didn't include them here, I don't believe. Yeah, I didn't. A slew of home construction names that are trading north of their 200-day moving average and potentially breaking out to all-time highs. We've traded a couple of them. AZEK, BLDR, right? Go and do your homework on those. Let's move into the final portion of this webinar here. 10 out of 11 sectors are trading north of their 200-day moving average. The only sector that just flipped red actually was energy. Energy, the one area of the market that has just not performed well for a long time. If you saw the tweet I put out a couple of hours ago defining what a bearish momentum regime and a bullish momentum regime is, if you didn't see it, at How to Swing Trade on Twitter, it will give you an insight on how we use that term, the momentum regimes. We don't want to own things in downtrends, and unfortunately, energy has just been in a downtrend after breaking above its 93 area into potential 10-year highs and then fading. We don't buy downtrends. We do not buy dips in bearish momentum regimes. Every other area of the market still holding up, although tech is lagging, only above its 200-day moving average by 1.35%. Move on to some emerging market names. We're going to wrap it up with the dollar, and then that's it. C Limited here. We're just waiting. This is a fantastic trading opportunity, but we want to wait until $88 or above. We took an early crack on this. It didn't work. That's okay. We want to limit our losses by not doubling down on this stuff until it clears overhead resistance. 90, 88, anywhere up there. Stage 1 into a stage 2. We've been here for 2+ years. This looks like a picture-perfect stage 1 into stage 2. We will own this 100% above 88. Set your alert. When it's up there, ping me. Go, yo, we're up there. Are we owning it? We're already looking at the options at that point, right? Want to own it up to 120.75 above $88. Until then, we want to wait. And then Coupang, CPNG, the South Korean Amazon, I believe, right? We do own this. We went out to February. We just had a 2-year plus high breakout earlier today. An opportunity for you to tail the trade if you want. We had an option to buy the December, January, or February's. We got the February 2025 $25 call. Yep, we went really far out there. 5-6 months at the, when we originally bought it. But when we were looking at the trades, we were looking at open interest and volume. And there was, for whatever reason, an elephant print on the options chain. For those of you that know what that means, either a dedicated buyer or some sort of service or whatever was just buying these contracts hand over fist, February $25 calls. And they were cheap. So we said, why not just tail them? It's the exact same trade idea. We expect this to be a stage 1 into a stage 2, which it is. We're buying a couple extra months, right? 2 extra months is not going to kill anybody. Didn't really bring the value of the trade up too much, dollar amount wise, but we're within a bullish momentum regime, right? We're trading north of a 200-day moving average. This gives us some of that emerging market consumer discretionary exposure that is working right now, right? Consumer discretionary is not working so well in the United States, but outside of the United States, it is working well. For whatever reason, right? Coupang looks okay, so we're going to own it. Emerging market, this is your opportunity to own a name outside of the U.S. market. Wrap it up with gold and the dollar. Gold looks great. Don't care what anybody says. We have 2 trades on this. Both of them are positive. There's no reason to expect gold not to continue on up to 2750. Sounds ridiculous, but I want to be honest with you. When we were breaking above 2050, I thought 2300 was ridiculous, and it took 2 weeks to get there. We've consolidated since then. No idea what's going on behind the curtains there with the macro moves and stuff like that. I simply don't care. Enough people are giving their opinions on Twitter, and a lot of them have been wrong. The only thing I know is I wanted to be long above the range high at $2,050, and we got it. And then we wanted to add into a pullback to 2,300, and we got that too. We're currently up on both positions, not looking to add here. We're in the middle of a move. Price target 2750, excuse me. Silver has not performed well. We have not taken a silver trade as a community. As far as I know, I never took it for whatever reason. Not up for me to decide. Silver is not performing as well as gold. I'm not here to argue why. It just isn't. So we're not going to own it definitively until we're within a bullish momentum regime and above 27, right? We can all shake hands on that. The dollar is the last thing I want to talk about. The dollar. Inverse correlation, right? Inverse correlation between the U.S. stock market and the dollar. When the dollar goes up, the stock market tends to face headwinds. We tend to have choppy price action. When the dollar goes down, the stock market tends to perform better. Now, it doesn't mean that the stock market has to roll over if the dollar is moving up, but it typically means there's headwinds there. So we have been in a relative downtrend in the dollar. This this correlation has existed for the last 2.5 years. And now we're bouncing off of previous support going back 2 years. Is it reasonable to assume the dollar finds support here? Yeah. Has it over the last couple of days? Yes. Has the stock market shuddered a little bit the last couple of days? Yes. None of this stuff is coincidence. These relationships exist. My question to you, and I don't know what the answer is do we eventually break 100 or 101 and start breaking down from this range? Or do we go all the way back up to the 106, 107 area and potentially break the range high? Or do we just continue to oscillate? I don't know what the answer is. But understanding that inverse correlation is imperative, right? If you know that the dollar is going up, the stock market is being choppy, you go, well, shit, I expect that to happen. As soon as you see the dollar start to drop, you've reasonable expectation that the market is going to normalize and potentially start ripping back up. Well, shit, I kind of knew that, right? So keep this always on your watch list. The dollar, you can recreate this trading range. Everybody on Twitter has the same range. It's very apparent 2+ years. My big question here is, do we eventually flip this to the downside and start a downtrend? Because if that happens, I think markets are at all-time highs across the board. Okay? So big themes here. Seasonal September, we went through it at the very beginning. It's the weakest month on average. Have that expectation now. Stock showing leadership through the end of summer, led Q4 of 2023. No reason to expect that to change, particularly within the high beta area. Create your watch list now of high beta stocks that are holding up better than the broader indexes. Those are typically going to outperform when or if the high beta area starts to rebound, which we think it will. Buying strong sector breakouts with time has been the key over the last couple months. I didn't show a trade that we put on back in February, but we took a CARR trade, an industrial related name, February to September. That trade was 100% winner on Friday of last week. Most people can't sit in stuff like that though, but that trade is working. Those are the types of trades that are working right now. I'm not saying you have to own it for a year, but buy more time than you reasonably expect if they're lower volatility, guys. A bouncing dollar could prove headwind for stocks. Again, it's been that way for 2+ years. Points of emphasis: rotation should not be construed as rollover. I just proved to you 6 sectors, all-time highs. Equal weighted S&P 500, all-time highs. The Dow Jones Industrial on Friday, all-time highs. And yet we have significant weakness in semis and tech. Rotation should not be misconstrued as the markets are rolling over. It's simply that higher beta stocks right now are not performing as well as lower volatility. That's where you should be focused. Market breadth is increasing, even as indexes chop. To bears' dismay, this is not what they want. If they want their market to fall into new lows, a majority of the stocks in the market have to be falling as well, and it's just not happening. Lastly, do not get complacent. Same advice as last year, guys. Biggest wins come after correction. If this summer weakness continues through the end of September, look for those relative strength stocks, build that watch list. In October of last year, we bought Meta. It was a $200,000 win for us. No shit. We bought ARM. We bought semiconductors. We bought App, which was the first 1,000% winner for a bunch of people in the Discord that had joined over the summer. All of those stocks were showing relative strength during the summer drawdown. Telling you, I'm arguably one of the most biggest secrets I guess I can give you. It's not really a secret, but nobody really uses it. Find stocks that are outperforming the index, because when the index flips and starts back up, those stocks should outperform. There's a reason why financial institutions aren't selling those. My name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, you can like and subscribe. If you want to join our service, link is above in chat. Feel free. It's a quarterly membership. If you have any questions, you can also reach out to me. I'll be happy to help. I enjoy this time. This is my favorite time of the month, these monthly and mid-monthly charting sessions. It allows us to take a step back, not give into the doom and gloom. Eventually, the market will roll over. Eventually, there will be a bear market, and we will be there to cover it. That is not right now.